Thank you so much, everyone, for watching. You're here with me, Shannon Paul. I'm from Paul Real Estate Group and All Stars Realty. I've been in the industry for the last 4 years. I've been an entrepreneur and buying and selling homes of my own for the last 15 years. And I'm super honored to bring you the information about how to purchase a home, what are the myths and the facts, and especially right now during COVID, what's happening in the marketplace and how does that affect us and our investments and our value in our homes moving forward. And I'd love to introduce to you my co-host and my partner in crime, Gina Howard. I'll let you introduce yourself.
I am Gina Howard, for those that I haven't met yet. Hi, Khadijah. I've been in the business, mortgage industry for now 27 years. Yes, I sold my soul, but I love it. I am very passionate about it. Obviously, that's why I'm still in it. And I am with Movement Mortgage, Senior Loan Officer, and Movement's known for their, first and foremost, customer service and great rates and quick closings. Never have to worry about not closing on a loan with Movement. So glad you guys are joining us and look forward to hearing all your questions and concerns, and hopefully we can put your mind at ease.
Here we go. Let's roll. All right. We're in the home buying seminar and we're going to start. This is me and my information. Here is Gina and her information. We'll provide it for you later as well. All right, we're going to go over the 5 myths about buying a home in today's market. And I'm sure some of the questions are going to be around COVID and safety, and know that we're going to talk about that and we're going to do a deep dive into the market. So don't worry if your question isn't answered in one of these top 5, but it will be answered. So number 1, this is for you, Gina. You must have 20% down. What is that about that myth? Can you tell us more?
Yes, absolutely. That is indeed a myth. You do not have to have 20% down. Although it is nice, more times than none, especially in California, it's a little hard unless you've had a home that you've previously sold. When you're trying to save, especially if you're a first-time home buyer, it's a little tough. So no, you don't have to have 20% down. We have some great first-time home buyer options, whether it's the Fannie Freddie 3% down, depending on your income criteria. We've got the FHA, as always, that's 3.5% down. VA is 0% down. And we do have the CalHAFA, which is a down payment assistance program. They all have their own criteria, guideline restrictions, things like that. And those are the things that we can go over when we talk individually about your own personal scenario. But don't let it fool you. You don't need 20% to get into your home.
Awesome. And then if you guys have been watching the market, it's been all over the place, from loans to economy to rates, etc. But a lot of loans had gone offline over the last couple of weeks. And what we're starting to see is those loans come back online. So that's a good positive sign for real estate and the real estate industry and the economy as a whole. All right. Number 2, you must have a perfect credit score. Is that true, Gina?
No, that is not true. We had a little change in the last month to some of our guidelines on some of our programs. We were down to 580 on government loans. They briefly put that on hold just in fear of possible recession. But since we're bouncing back, and Shannon will get into that later, we've actually changed our guidelines back to the way they were. We'll go back down to a 580 credit score for your FHA and VA loans. And then our conventional is 640 and above. However, it is nice to have great credit because that's going to help you get the best rates that are out there. And if you have concerns about your credit, then we can certainly discuss how to get your scores where they need to be, whether it's paying off some credit, doing a rapid rescore, things like that. And again, we can get into those details on a side conversation. But no, you do not have to have perfect credit scores to get into a home loan.
Awesome. And Gina and I were talking the other day, getting ready for this, and during COVID and everything that's been happening, they tightened up the rules a lot. So when you used to be able to have a 580 score, they tightened it up and you couldn't get a loan unless you had, 640, 630. But now they're loosening those standards again back to what they were pre-COVID, like Gina said. So that's just really great information. Obviously, the better your credit score, the better rate you get. And Gina, can you tell them what is considered excellent credit?
Excellent credit is 740 and above.
Okay.
And, obviously, again, that's going to get you the best rate out there. The rates that you see advertised. That's another thing is the things that media put out there. It's not a blanket rate for everybody. Rates are based on a combination of things. It's your um, how much you put down, your loan versus your value when you're looking at buying a home or even refinancing. It's your debt versus your income scores, your ratios. The higher max to your limit ratios, that might ding, your rates, things like that. Your county, your loan amount limits, everything all plays a factor in what kind of rate. So when you see those rates advertised on the media, just know that's going to be for your 740 and above scores with probably at least minimum of 20% to 60% equity in your home. So I know it sounds all great on the TV, but each and every person's scenario is different, and therefore each and every person gets a different rate.
Okay, good. Oh, and Gina, I wrote on my notes, don't buy a car. Can you tell me about that just real quick?
Yes, definitely. So I get that all the time. Hey, I need to buy a car, but I want to buy a house. Well, it depends again on your own personal scenario. And if you really need a car, you really need a car, and there's just no way around it. But if you are truly serious about buying a home, then you can hold off on buying a car, wait, because that payment that you have, or if you almost have it paid down, or if you have a car payment that's less than 10 months left on the loan, we don't have to count that in your debt versus your income ratios. So again, that'll give you more buying power. It also, keeps your scores good. Once you buy a car, it's going to ding your credit and bring your scores down, and it'll rebound. But again, just keep those things in mind when you're really contemplating whether you should buy a car or a house. What's more important? And again, if you need a car, you need a car. You need to get to work. You need to take your kids, to and from. I get that. But if you are really, really serious about buying a home and your car it's just because you don't like it or it's older and you might want a new one, you might want to hold off, buy that house first. And then after you buy the house, whatever you want to do after that is fine. But you want to make sure you qualify for the house and be able to get the max buying power as possible without dinging your credit and having to count, because most car payments now are on average about $600 a month. So that's huge. That's a huge takeaway from what you could buy. Makes a difference.
Absolutely. And then too, to piggyback on that, even credit cards, the average American has $16,000 worth of credit card debt. Yeah. And Gina and I were talking yesterday, and her pitch, or not pitch, her thing on that was that to pay down the 40 to 50% of that credit card to open up your credit and to give you better credit. Is that accurate way to say that, Gina?
That's correct. So kind of back to what we're talking about as far as bad credit scores or not having the best credit scores. If you want to improve your credit scores or you want to give yourself a little more buying power, pay those credit cards off, or at least bring them down to 50% of their balance. So if your balance is 5,000, or your limits, excuse me, if your limits are 5,000, you want to bring your balance below 50%. So try to keep them below 2,500. Okay. If you don't have a whole lot of credit, I know it's a catch-22, but go get yourself a secured card. It doesn't even have to be much, $500, limit, and use it for gas, use it for groceries, turn around, pay it off. Any of those things are going to build your credit and offset any bad or old credit or no credit that you have. So it's always good to use credit because it shows the lenders you're able to manage credit and pay it off. And like I said, it doesn't have to be anything extreme. $500 looks good. So keep those things in mind. And, and then also when it comes to a mortgage payment and you're used to paying $3,000 in rent, and now you want to buy and your mortgage payment's now going to be $3,500, and that kind of makes you feel uncomfortable. Well, look at your credit cards and add up how much you spend every month on those credit cards. If you pay those off, there's your mortgage payment. There's your extra $500 a month that you could put towards a mortgage versus paying on, department store cards or frivolous spending, things like that. So just keep those things in mind when you're looking to buy.
I love it. Thank you, Gina. And that payment, of course, will go up and down depending on the size of the home that you're buying, whether it's a condo, a house, or a bigger house.
Absolutely.
Gina, can you look in the chats and just see if there's any questions? If you guys have any questions, please feel free to drop some questions in the chat or in the Q&A, but I think we're both on the chat right now. I just can't see it from my view.
I see it. I'm not seeing any. let me know if I'm missing it, but.
Okay. So we're going to get into the number 3 is it a bad time to buy a home? And I'm going to get nerdy with you guys. I am a data junkie. I don't know if you know this about me yet. And if not, you're about to find out. Now, Gina, if I go into this deep dive too long, you pull me out. Okay, girl?
Okay, all right.
Okay.
I'll bring the snorkel gear.
All right. And if you guys have questions about this, please pop it in the chat. Gina's going to be following the chat and we'll answer any questions. But here we go. Deep dive on the market right now and what's happening. Here we go. All right. So this is a graph about home prices and the changes over the last 5 recessions. Now, if any of you guys remember, a lot of us have PTSD from the recession in 2008. And Gina, I know you can back me up on this. Lending standards were terrible then.
It was free game. I mean, you could get a house better than you could, faster, easier than you could get a car. It just
Right.
it opened up the floodgates, and yeah, it was a stated income, stated asset, and all you had to do was write down what you thought you made, and
Which could be fraudulent, what you made or what you
you
thought you
know,
made,
yeah,
right?
it really opened, and this came from Wall Street down. So, it wasn't like loan officers made up these rules. It
Right.
was what was out there. And unfortunately, we saw what happened with those kind of crazy programs.
Yeah. So this 2008 that happened was because of loans. The recession that we're embarking on right now, and because of the health crisis, it's causing the economic crisis. But the economic crisis is not causing a home crisis. They're two different things.
Good way to put it.
2008 was a home crisis or a lending crisis, which caused that crash. If you take away 2008 and you look at these other ones, the gray bars and the one green bar, 1991, we saw homes depreciate, and that was the only one out of the other 4 recessions. The other 4 recessions, we actually saw home values increase. All of the data that I'm going to run you through, it's not my opinion. My opinion, I think, is pretty good, but you know what? It's not about that. It's about the data. So I'm going to tell you the data. So data shows out of the other 4 recessions, 3 out of those 4, we increased in home values, which makes me happy as a homeowner. It makes me happy as a realtor to help you secure an asset that's going to appreciate in wealth. And I think I just saw a chat come up. Gina, if you want to let me know
Yes.
what the question is.
So Jay's asking, I'm seeing more and more home inventory for sale in the markets we are seeking to buy in. Won't that affect home prices downwards?
Good question, Jay. I love it. So I'm going to keep going through the data, and I think that I'm going to answer those questions through these next couple of slides. And then Gina, if I don't answer that question directly, bring me back to that question, would you?
Okay, perfect.
Okay. Because I think I'm going to get you in this, Jay. All right. Can you guys see this graph? Oh, Gina, can you see the graph okay?
I can.
Okay, perfect. If you can, they can.
Okay.
So this one, I had another slide in here and I just put this slide in its place. And Gina, looks like we've got another chat because the information just was updated. So we just had Q1 GDP information come in and we're negative this first quarter, as we had expected, because we're in a crash, right? We're in a health crisis. Now, what this is showing is that how we're going to recover and what should we expect coming out of this. Now, this is not a fun time for anybody, but we're following the most educated people that are guessing and giving us direction on what's happening. So major financial institutions are calling for this V-shaped recovery. So if you look at Goldman Sachs, JP Morgan, Morgan Stanley, and Wells Fargo, they're all predicting, yes, we're going to go down. And right now we're sitting in Q2, we're going to see a downturn, right? We're going to hit bottom, not bottom, but we're going downward fast and furious, and then we're going to come out of it. As this virus goes away, as we start to reopen, we're going to see the economy tick back up. And all major banks are predicting the same thing. This is a good sign that this is what all the major players are predicting. Did you want to add anything to that, Gina?
No, I mean, you're absolutely right. It dropped so fast just because basically we're all kind of paralyzed with fear. We didn't know what was going to happen. We're all shelter in place. It just, everything kind of came to a halt. But as you can see now that things are starting to lighten up and we're getting through this, we're starting to rebound. So now people are leaning into it instead of being frozen in fear.
Absolutely. So with this one, and I'm gonna call it a recession. I'm gonna say the R word, because if we're not in it, we're headed towards it, and the media is gonna make it a big stink, right? Because the media has a lot of negative news, but it is scary out there, and I'm not making light of the situation by any means, but I want us to look at the data so that we can predict our own wealth growth from here on out. That's what this is about. So if you look at the black line, that's us right now with the COVID-19 and what the projections are, and this is unemployment. So they're suspecting and projecting that we're going to hit 15% unemployment, and then we're going to come back out within this first year and in the beginning of the following year. If we compare this to the Great Recession, that orange line, we went down to 9%, but look how long it took us to get out of it. We stayed down for a long time. So what they're saying is that the COVID is more like a natural disaster, more like a 9/11, where we can,
Right.
it's hard and fast on the way down, but it's going to be hard and fast on the way up too.
Yes.
If we compare these unemployment numbers to the Great Depression, we really took a hit back then. And we stayed down for a very long time, and it was a 12-year span for us to get out of it. So the reason I show this slide is that, yes, unemployment is a thing right now, and I feel terrible for anybody who's lost their job right now, and I'm hoping and praying that everyone gets their job back very quickly. But as we look at this as our nation as a whole and how it affects us as a whole, there's light at the end of this tunnel in that we're going to come out of this quickly and recover.
Agreed.
And what's neat, and I didn't put this chart in here, Gina, but that employment, unemployment, and home prices do not correlate directly,
Right.
which is fascinating. And if anyone has questions about that, I can have a side conversation with you and show you that slide as well. I have like 20 slides in here, and I couldn't put them all in.
They're all so good. They're also very informative.
Yeah. So if you're considering that this might be a housing crisis, please think again. It's not going to be a housing crisis according to all the predictions. And here's something that helps support that. And Jay, I'm hoping to get to your question through these as well, is in the last 6 years leading up to the crash of 2008, we had massive appreciation that was over the historic norm. And it just didn't make any sense. We saw anywhere from 8.5% to 12.5%. Now, if you look at the last 6 years in green preceding where we're at now because of COVID and the health crisis, we didn't see those numbers. In fact, we were going into our strongest year of sellers being able to sell and buyers being able to buy that we've seen in several years. And because of the health crisis, it slowed things down. Obviously, we don't want to leave our houses.
Right.
So this is another supportive piece of how did we get to 2008 and why are we not there right now? How is this different than 2008? Well, back then, because of the housing bubble, mortgage standards were loose. That's the red thing. That's the red housing bubble at the top of the screen. I want to point, but you can't see what I'm pointing to. And the green is today's standards and how tight lending standards are today to get a loan. It's a lot harder to get a loan now than previous.
Yes. I've been in the business since '93, and after the financial meltdown of 2008, struggling through to stay in this industry, it went back to the way it was in lending, back in the 90s. All your tax returns, it was every piece of paper under the sun again, because they went from one extreme to another. Wall Street created these crazy programs, 2-year fix, all these prepays, these option arms that just you couldn't get out of. And your fixed rate went away, and then it increased, and nobody could afford that same payment that they originally got into, and therefore led to the short sales and the foreclosures. And after that, we don't have those programs anymore. It's pretty cookie cutter again. It's 30-year fixed. It's your 20-year fixed, 15-year fixed, 10, and arms. Nobody even wants an arm anymore because they're afraid, every year what's going to happen. It can be a good year, it can be a bad year. So arms, even though they're fixed for 5 years, 7 years, where's the rates going to be in 5 and 7 years? A 30-year fix when they're this low, like they are now. Why not lock in a 30-year fix? You never have to worry about it again.
Absolutely. I was just going to say that, Gina, and you stole the words right out of my mouth. And I know most of you guys on this call don't own a home right now, but if you have any friends that own a home and they haven't refinanced, please tell them to refinance, because now is an incredible time to refinance. Whether you do it with Gina or whether you do it with someone else, just tell them now is the time,
Yes.
because we're seeing the most historic low interest rates we've ever seen.
Yes. Last time I saw rates this low or even close to this low was 2015. And prior to that was 2012. So, 3.1, 3.2, 3.3. That's insane. Do you think about all the interest rates you pay on your credit cards, even your car payments?
Yeah, I bought last year and my rate I think was like 4.5, and that was really good back then. And now it's like 3.5. I want to refi. I'll be talking to you, Gina.
Exactly. There you go. 2005, and we were at 8% on a 30-year fix, and people thought that was amazing. So when people say, "Oh, these rates are high,"
you can't get money this cheap.
Yeah, and if you think they're going to drop down to the twos, you don't wish for that, because with that comes a lot of other things. A possible recession, possible more job loss. You might not even be able to refinance to get that 2% if you don't have a job. So if you like that rate and it makes sense, do it. Lock it. Save yourself some money.
Good. So this slide is going to help answer the question of, okay, is now a good time to buy or not, in conjunction with all the other ones, because this is talking about what everyone wants to know is it a buyer's market right now? We're having this health crisis. I'm hoping and praying, this is a lot of my clients, like, please let home prices tank so I can buy low and have a lot of equity. And on one hand, I wish that was the case just so all of my clients could get smoking hot deals. But I don't wish that was the case, because that would mean a lot of people are out of their homes and really struggling, and that would just tear me apart. So when we look at this, a buyer's market by definition is there's enough inventory, there's enough homes on the market for us to buy within 7 months. Like, it would take 7 months for all those homes to come off the market. Now, a seller's market, what we're coining is by definition is 6 months of inventory or less. And then in between is a neutral market, that's 6 to 7. Going into this just before COVID, we only had 1.5 to 2 months of inventory in most parts of Southern California. Now coming into COVID, we have even fewer amounts of inventory. It went down into the 1%. And it makes sense. You're going to see all these crazy headlines coming out of like, oh, historic low numbers of houses that are not available for sale. And that's true, because everyone's in their home hiding from the virus. So why would they put their house on the market? Well, now what we're seeing, and I'll get into another slide, let me see if this is the next one, is that, oh, I have a lot to talk about. Wow, I'm going to hold that thought. Now what we're seeing is that homes are coming back on the market, and we're figuring out virtual ways to do business. It used to be that we did everything virtual for all of our relocation clients, but now the whole globe is doing real estate virtually. In fact, what's interesting is China, when they reopened, they had in most of their counties, they saw homes go on the market 3 times more and transactions happening 3 times more than what they were seeing pre-COVID, which is insane. I am hoping that answered the question. Did I miss anything on that one, Gina?
No.
Okay. So another reason why the data is showing that we're not going to see a whole flood of foreclosures come to the market is back then in 2008, people were using, and I'm going to steal your line, Gina, using their homes like ATMs and just pulling out money to buy the fancy cars and the boats and whatever else they wanted to. And they took out a total of $824 billion. Since then, we all learned our lesson and the banks learned their lesson. And now people up to this point in time, as COVID hit, they'd only pulled out $232 billion, which means they have equity in their homes. In fact, 50%, well, 53% of Americans have at least 50% of equity in their homes, which is awesome. If you know what equity means, it means when you're paying your mortgage, the home mortgage goes down, and over time, the value goes up, creating more money that goes in your pocket when you go to sell your home. And if you look at this stat at the bottom, 177,000 of equity is in each person's home, which if they've lost their job, God willing, they get back quickly, but they're probably not going to sell because they have so much equity. they're not going to sell at a major discount because they're not going to walk away from all that hard-earned money. They're going to want every penny.
And to that, you know, when you're thinking about buying, if you haven't bought yet, this is the fastest way to gain a savings. It's faster than a 401k, an IRA. This is how people leverage. They get into their first home, might not be their dream home. They get in, they build up all this equity, and then you have a nice chunk of change put down on your dream home.
Yep.
Getting into your first home is the best way to start acquiring, quote unquote, a savings.
Yeah. And there's a chat that just came up, and while you're looking at, oh, you want to go ahead?
Paul says, need to leave. Thanks for presenting this information. Thanks, Bradley.
Thank you. What was really interesting is I had a client, her name was Kelly, and she wouldn't mind sharing this. We're going to do an interview with her anyway. So
awesome.
She had a condo. Gina helped with this particular client, and her condo, she had just about that, 177 in equity. I think it was a little more or a little less. I can't remember exactly, but she was able to sell her home and buy a duplex, and now she's living, her payment at her condo was $1,300, and now her payment for her portion of her duplex is $1,300 or $1,375. It's right in that $1,300 range.
Yes.
And her other half pays the other part of the mortgage at $2,600, and so she's covered. And she has a house. She has a higher price point. She's got a lot more equity in this property and a lot better sales strategy on the exit when she needs that money again or she wants to move again.
Absolutely. It was very smart. It was one of the smartest transactions I've seen in a long time. It's the example of how you use your home as leverage to get into a bigger home or a home with a higher value to use.
Yeah.
And keep building that savings, that nest egg.
Yeah. And I'm going to go back to this to answer Jay's question more specifically. It's like supply and demand. When we don't have any supply and we have a lot of demand, prices are going to stay where they are. And right now we don't have a lot of supply. And so as homes come to the market, it's going to help feed that buyer demand because we have pent up buyer demand. People are sitting in their homes right now, searching the net, wanting to find their next quarantine house. Trust and believe.
They want out now.
They want out. Some are glad they're in their house, and some are like, get me out of here. This is crazy.
All right.
And this is a great slide to show. This is from Zillow, and Zillow tracks all showings, and they're a fantastic company for information. Traffic has since picked up since March 22nd, outpassing April, end of April last year. So people are bored. They're ready to go. They're surfing online. They're ready to get out.
Yes.
And this is another piece of data. So, this is not my opinion. I will give you my opinion because that's what I'm here for, but it'll be based in data. And if you look at this data, the impact of COVID thus far with showings in North America, we were doing a lot of showings. And right at March, when this COVID hit, you can see that the showings declined tremendously. And they should. We're at a stay-at-home order. So we had to go back inside our houses. Well, since then, as people are getting tired of it, and as people are feeling more safe and not as fearful, we're starting to see the shoppers hit the market again. So when I say there's this pent-up demand, all these buyers are ready to go looking at property. And they're doing that online through showing time, and they're also making appointments, which is what this data reflects. And just to give you a little local, I'm in Long Beach right now, and this was just a quick snapshot so you could see what's really happening, and I can do this for whatever marketplace you're in right now. Just in the last 7 days, we had 14 properties sell and 45 come to market that are now new and listed. So the question of, are transactions happening? Yes, they are, and I'm going to explain how to do it safely, but I want you to know that things are happening. Now, this is not as it was if we would be pre-COVID. These numbers would be a lot higher, but business is still happening. And the way business is happening is it's safety first. I mean, I don't know if you guys follow me on Instagram or on social media at all, but I'm trying to put out as much content as possible because it's a scary world right now and we're all wearing masks and afraid to go out. But to be honest, you're more likely to get COVID at a grocery store or Home Depot than you are to go see a house.
100%. 100%.
And I say it jokingly, but I'm serious, because the way that we're doing virtual home buying now is that we, number one, let's say you're interested in buying a home. We look at the photos together online. Number two, we do a virtual home tour through a video or a seller guided tour. And then number three, we have you drive by the property, go see if you like the area, and then and only then are we then going to schedule a tour. A lot of homes right now are vacant, which is great because then we can go no problem. Or if the seller's there, the seller leaves. The way it works, we turn on all the lights, we open up all the windows and doors, etc. And then there's a no-touch policy. So usually the seller's done all that for us. You go in with a mask, gloves, and booties. You do your thing, you look around, you come out, and then I go in. So you and I never have contact with each other. We never have contact with the seller, and we have no touch policy. So you're in and out, you're very safe, and then we jump in the car and have a conversation about, all right, what did you like? Did you love that house? Did you not like that house? And that's actually a lot more efficient, and my buyers are loving it. They're absolutely loving it.
Own personal tour. You don't have to be in there with 50 other people at an open house. I'd feel special, actually.
It's like a private tour, yeah.
Yeah, exactly. Like the mansions they have in Beverly Hills, that's how they have to do it, one at a time, and no open houses. So take advantage of that, so you're not in crowded in a house with a bunch of other people. You get your one-on-one.
Yep. And what's interesting too is that sellers, and what's required now with California law to the degree, is you have to be pre-approved before you go in the home, and you have to sign a disclosure stating that you understand that you're shopping during COVID, so in case you're sick or if anyone else is sick. So it makes it good for the seller that it's a qualified person coming to look at the home. And it makes it good for the buyer, because if you're pre-qualified going into a property that you love, let's say you're qualified and you can spend $2,800 a month and that's it, that's your max, or $4,500 a month and that's your max, whatever your number is. And let's say you find a home and it's going to cost you $5,000 a month, you're going to be really sad when you walk out of it and you can't afford it. Now going into it, having that pre-approval and understanding what you can afford, that makes the world of difference, because then when you see it, you don't feel depressed. You feel excited that you can do this. I just had one close, I think 3 days ago now, and it was a duplex. And my client, we did virtual inspections. We did virtual final walkthrough, and they still closed their house during COVID with these new parameters in place.
Transactions are still happening. You still sign your docs, and there's really no reason not to.
Yeah. If you're in the chat, if that makes sense, could you give me a thumbs up or a yes? Or if you have any questions, can you pop something in there? I'd love to just see what your thoughts are and see what you have to say.
Come on, don't be shy.
And if you're shy, that's okay. You don't need to, but it's always great to hear from you guys and see what your thoughts and feelings are and what we just talked about.
Thumbs up, totally makes sense. Yes, makes sense.
All right, fantastic. Thank you guys. It's good. It's weird not being able to see you, so
I know.
I get energy off of you when you chat away, so thank you. I can't wait to just hug you guys all again and see you face to face and do the nerdy high fives.
Totally.
All right, very good. So this is a question for Gina, or a myth you should purchase at the top of your pre-approval.
And that is a myth, and that is a case-by-case basis. Back to what Shannon was saying, as far as getting pre-approved, yes, you should always, that should be your first step. I know, like, my analogy is, I know we all like to window shop, and as girls, you like those Manolo Blahniks and you fall in love with them, and then you try them on, everything's great. And then you look at the bottom, you see what the prices are, your heart drops, and you're no thanks, they don't look as good. So that's kind of the same analogy I use for buying a house. You go out looking first and you fall in love with this house, and then you work backwards and you calculate out the payment, and your jaw drops, and then you're sad because you just fell in love with the home, but you didn't fall in love with the payment. So what we like to do is talk through everything, yes, I'm going to pre-approve you to the what you are maxed out at, just so you know, so you have that buying power, that counter offering ability if you do get in that situation. But is it, should you always? It's what you're comfortable with. Most importantly to me, customer service and being in the industry as I have and looking out for my clients, I don't talk them into buying at the top end. That's up to you. If you want to keep countering and go to the top, that's, that's, as long as you're comfortable with that payment, that's great. But is that where you should start? No. When we go through the numbers, I'm going to present to you what that mortgage payment's going to look like based on that, the mortgage payment looks like based on that purchase price. And then you tell me, is 3,500 a comfortable payment for you? No? Okay, well then we need to look at some other options, either a lower purchase price, maybe putting more down, maybe looking at a different program, things like that. So it's not always, yeah, absolutely go to the top, because the top might put you in a payment that ultimately you're going to resent. So I talk to people individually, case by case, what their comfortability is versus what looks good on paper.
Absolutely. And to be quite honest, and if you know either one of us or you've had any interaction with us, we're not salespeople, we're educators. Our goal is, and my goal and kind of why I got into the business is I want to help people build wealth. I bought a condo as my first property and we turned that into a house, and I feel so great sitting in my house, and I feel so good sitting on this equity. It just makes me feel powerful. It makes me feel wealthy. It makes me feel like I'm an adult.
And you got a nice savings, nice nest egg, because ultimately you want your money to work for you. You don't always have to work for your money. So having equity in your home is the best way to have that money there for you when you go to retire or whatever your long-term goals are. It's nice to have that.
Absolutely. And when we sit down together, we do a budget, we go over what you can and can't afford. And my favorite part of doing the budget with someone is they write everything down, and then I say, well, here's how much you spend and here's how much you make. Where does the rest go? And they look at me and they go,
oh,
I don't know.
How many trips to Target? How many times do you eat out? We all do it. We're all guilty of it, but that's what we're here for, is to guide you and talk you through all those things and make sure it makes sense, and not just push you into something that makes you feel uncomfortable. That's not me or Shannon. That's why we make such a great team, because both her and I look at our clients, view our clients the same way, and we treat them like we would want to be treated.
Absolutely. And we talked about rates earlier, and this was actually pulled, Gina, from just a couple days ago. So you're obviously going to have a handle on where rates are at as of today, but this is a really great chart nonetheless of if you bought a house at 4%, even back in December, versus if you bought it today with this lower interest rate, over the life of your loan, you're saving close to $30,000. That's
Absolutely.
incredible.
It is. It's insane. It is a great time to buy, and it's a great time to refinance. I can't reiterate it enough. I haven't seen these rates this low again since 2015. Who knows how long it's going to take, especially after this re-election. God knows what's going to happen there. Usually with the re-election, rates go back up. So now's the time. And, low threes, it's unbelievable. And again, it gives you more buying power, and rates do change all day, every day. So they're not set. They're not fixed like, oh, I might wait and get back to you a month later. Now, if you're purchasing, that's a whole different story. It's all going to come down to when you find your house and get your offer accepted. But refinances, people, want to wait. I've seen so many people miss the boat because they thought it was, going to drop down to the twos. And 27 years, I haven't seen twos. Maybe for a 15-year fix, but a 30, unless you're paying some points, it just, on average right now, I'm seeing anywhere from about 3.1 with the best credit, the most equity, to about 3.3. And then it also depends on if you're, buying, if you're refinancing, if you're taking cash out, all those things come into effect as far as, again, what rate you get. But
Mhm.
Ultimately, overall, they are even better than they were last year. And we weren't even in a crisis last year. So
Yeah.
this goes to show you never know what's going to happen with the market. And if it looks good to you and it saves you, I don't talk anybody into refinancing or doing anything unless it's saving you $100. But if you're buying this, again, back to buying, buy now, buy now, get your
And
foot in the door now. I mean,
and we wouldn't just say that. If you guys know us, we would not tell
no,
you to buy now.
no, I
You know,
tell you
like
what,
if you were going to start a flipping business right now, I would say no.
right.
Don't start
That,
a flipping business right now. And then I can give you all the data to support that. So just know that we're not talking about this stuff to get you to buy a home. You have some level of interest in buying a home, and we want to give you the data so that you can make a good decision. If I was buying, if I was in a position, which I just bought last year, so you know, if I was buying now, I would grab this right now and run with it, because homes are going to appreciate anywhere from 3 to 6% next year, which is what the economists are predicting, even with the crisis at hand. And you have a 3% interest rate. I mean, that's like a 9% gain. It's just crazy. So
yeah.
I can't stress it enough. This is, in my opinion, which I said I wasn't going to say, based on the data, it's an excellent time to buy.
Agreed.
All right, number 5, is it cheaper to buy a fixer upper? Can I start with this one, Gina?
Please go ahead. I feel like I've been talking a lot, so go.
Okay, so I have a lot of clients that want to buy fixer uppers, and I'm all on board. I love fixers. I actually bought a fixer, but there's rules around this. So is it cheaper to buy a fixer? Yes and no. It's a double-edged sword. If you can get in and it's a cosmetic fixer and you can do some updating to the bathrooms and the kitchen, it's a great way to build your equity. Now, if it's a disaster of a property or it's falling apart, maybe not. If you don't have the funds on hand, if you don't have 50,000 liquid cash sitting around, maybe buying a fixer is not the best opportunity for you. And maybe you should buy something that's already turnkey, ready to go. It depends a lot on your personality and also the amount of cash reserves you have on hand, because a kitchen to redo it can be as cheap as $7,000 and as much as 25,000. A kitchen can be as low as 35 grand up to 150 grand, depending on your style and the likes of your finishes. If you're that kind of person that wants to do that, awesome. If you're someone who just wants turnkey and you have busy lives and you don't want to be bothered, awesome. Those are some of the points around it. And Gina's going to talk to you about, from a lending standpoint, what does it look like to buy a fixer?
So to buy a fixer, obviously, first and foremost, it's got to pass an appraisal inspection. If it doesn't pass appraisal inspection, then you come to a crossroads as far as who's going to pay to fix what their appraisers has reported. Now, again, if it's cosmetic, that's no big deal. But if you're talking health and safety, especially if you're going with a government loan like FHA or VA, that can get really tricky because they are definitely a little more pickier on the appraisal side. They are going to look for things that normally on a conventional loan they're going to overlook. So if you think you can buy a fixer upper but go FHA or VA, be prepared. And the seller has every right to say, no, I'm not going to fix these. I'm selling it as is. And do you really want to, as a buyer, put money into a home that you haven't even closed on? So, so those are things to take in consideration. And like Shannon said, I'll just reiterate that if you don't have the side, extra cash to throw at it, maybe a fixer upper sounds all nice, but if you don't have the connections to contractors and plumbers, and it could get fairly expensive if you're going to hire people from Home Depot or whatever. That's fairly costly. So take those things in consideration. However, if you absolutely are insistent upon going after a property, we do have a renovation program with FHA and conventional, where you are allowed to finance in the repairs. And I'm not talking cosmetic. I'm talking whether it's major updating, so the house hasn't been updated since the 70s, or wood rot, termite damage, flooring that's the subfloor is falling out, things like that, roofing. Those can be financed in, and we can talk about that again on the side if that's something you really want to go after, and we know it won't pass the appraisal inspection. We can do a renovation loan, and you're basically going to finance what the value is going to be after all is said and done. So,
Awesome.
you're going to have to qualify on that, even though you might buy it at a lower price. Say you can get it for $350, but after all said and done, what you're going to borrow against to bring it up to par even is $500. Well, you got to qualify on $500. So, so we do have some programs. So don't let it scare you off completely, but just take those things in consideration before you jump into it and go, oh, I'll buy a fixer upper, and then you work, both you and your spouse work Monday through Friday, 8 to 5, and then some, or maybe on weekends, and you have kids. Who wants to do a project
Yeah.
for all that?
And
I
we have
don't.
both. We have both. Yeah.
Yeah. So yeah, right now at the stay home, you're working, teaching, and so it's exhausting. So just keep those things in mind if you are going to try to go that route.
And if you guys are looking for a fixer, I do have great contractors and great connections. So if you do go that route, obviously we'll have a side conversation when we sit down and discuss those as well.
And then Lisa just wanted to add, can I just say, anytime you make a shift from renting to own in California, it's only a win. And she's absolutely right. We also,
Yeah, thank you, Lisa.
thanks, Lisa. Lisa's a title girl. I've known her forever. She's awesome. So if you have any title questions too, that's a good one to ask any title questions too. But mortgage interest, just as far as that goes, even though you might be making a higher mortgage payment than what you're renting, you now have a write-off on your mortgage interest. That's going to help you with your taxes every year. It's going to offset that higher amount that you're going to pay on a mortgage versus rent, and you're paying your own mortgage and not somebody else's. So I know we all hear that all the time, every day, but it's true, and it's going to only pay off for you in the long run.
I agree. So I would love to hear if you guys have any other questions or if we answered everything for you. I'm going to stop sharing my screen so you can see my face bigger. And also so I can read the chat box. Does anybody have any questions that you'd like to ask?
Khadijah, do you mean PMI is deductible on your taxes? I want to say no, but that's a question for your CPA or tax preparer.
That's an awesome question,
That is a
Khadijah.
great question, and I honestly nobody's ever asked me that, but I think it's just your mortgage interest. I don't think it's PMI, and PMI eventually, if you're in conventional, PMI will eventually drop off or go away. If it's FHA, it's permanent. So I would say, Khadijah, if you have somebody that prepares your taxes, ask them. She said I got it confused with mortgage insurance. Mortgage insurance is the same as PMI. PMI stands for private mortgage insurance, and it's always going to be tacked onto your loan when you put less than 20% down. It's a way their lenders are going to protect themselves from exactly what happened in 2008. When you put less than 20% down, they look at it as you are not as invested. And I hate to say it, and that's not true, but you put 3% down, 5% down, something happens, market crashes, you walk away from $5,000-$10,000, big deal. But 20%, which 100,000, whatever, you're not going to walk away from that. Like Shannon was talking about earlier, when people have so much equity, they're not going to walk away from it. But the lender doesn't want to be left holding the bag like they did in 2008. So that insurance is there. But the good thing is, like I said, unconventional, it'll eventually drop off. You do not have to refinance to get rid of it. On FHA, it is permanent, but it's there to help you get into a home. Who cares? Use it and then get rid of it later.
Yep. Yep.
Any other questions?
Any other questions from you guys? I just put in the chat box, if you can see it. I put in all of my contact information and how to follow us on Instagram and social media, as well as Gina's.
Thank you.
So you can, oh, here we go. Here's a question that we missed. Gina, how long would it take to move into a house if you pay it off and you didn't need a loan?
I didn't see that question. I'm sorry.
That's okay. It popped up in the Q&A, not in the chat box.
Okay.
Yeah.
How long would it take to move into a house if you pay it off and didn't need a loan?
So then let's see, maybe and Shannon, let me know if this is what you're asking. So basically, if you had more cash to put down is what I'm guessing she's saying, Gina. Mm-hmm. So let's say you put more cash down, then your loan would be smaller. And so it'd take less time to pay off your loan. Maybe that's the question. typically when you get a loan, it's a 30-year loan, and it takes the whole 30 years to pay it off, which is the way that the loan is designed. And you can get loans that are smaller than that. Some people do a 15 or a 20-year. And depending on the amount of cash that you put down, that let's say you buy a $500,000 home or $1 million home, whatever the price point, a $2 million home, whatever it is. Let's say the 500,000, but you put 200,000 down, your mortgage is only $300,000. And so it'll take you a lot less time to pay down that $300,000 mortgage than it would, or it would take less money than it would for the 500,000. But either way, you're in it for 30 years if that's the loan that you signed up for. I don't know if that makes sense. I hope that's the question that you asked. And I hope that I answered that properly.
No, if I pay off my home with just cash without a loan.
Perfect. So if you pay off your home, yeah. So typically when you buy a home, you have to have a loan unless you buy it in all cash. If you buy it in all cash, it's paid out straight ahead and you don't even have to have a loan. So rock on. That's the best way to do it.
Yeah.
You don't have to pay anything on anyone on your own money.
Right.
So when you have a loan, you're borrowing that money for a percentage. So let's say you're borrowing $500,000 at 3%, you're paying 3% to be able to buy that home. Whereas if you buy it out in cash, that $500,000 home, you don't have to pay that 3%, which is cool.
Right.
So cash is king and queen, no matter how you look at it, always.
Absolutely.
Yeah.
Oh.
All right. If there's any other questions, please shoot them in there. If you guys would like to set up some time with us and just go over your specifics, I put a link in there for Calendly. We can just chat and talk about what are your goals and what are you looking to accomplish and get to know you a little bit more on a personal level and help you navigate this process. I hope you guys learned a ton during this. I know we went deep into that market dive, but we kept our time, Gina, within an hour. It's 12:57 on the button.
Yay.
I see another question.
Okay, she says, great. How long would I have to wait to move in approximately? And Shannon, what will you pay all cash as soon as you close, right?
Yeah, so let's say you pay all cash. Let's say when we draw up the contract, it's between the buyer and the seller. So if the seller wants to get out of there quick with cash, you can close as quick as 14 to 21 days. If the seller needs more time to move out, they're finding another place, they're moving cross country, whatever that scenario looks like, at that point, it's a 30-day contract. So whatever we go into contract with, those are the timeline dates. But with cash, you can usually do 14 to 21 days. And there's another question up here too that I saw from Joe. Gina, could you answer this one? Monthly mortgage payments versus the same amount bi-weekly. What's better overall long-term?
Bi-weekly.
Okay,
it depends on the servicer. So most servicers now are letting you make biweekly payments. But I mean, the mortgage payment is going to be the mortgage payment regardless. And then if you want to make the biweekly payments, then that is going to help, pay your loan off faster and bring your principal down quicker. So yeah, if you have that opportunity to do so, or if you want to throw extra money at the principal, you can even do a one-time recast where, say, you get a pretty nice bonus at the end of the year and you want to bring that principal down. You can only do it once, but say you have 100,000 to throw out your principal, you can throw that towards the principal, call the servicer, have them recast it, and they'll recast the payment based on the new loan amount versus it won't change the rate, but it'll recast it based on the current balance instead of just making that same payment until you pay it off. So yes, to answer your question, Joe, yeah, biweekly is always better.
Always. Yep. And when you have more money, you can throw at it bi-weekly. And if you don't have as much money, you can just do it monthly like normal and then kind of make extra payments as you go.
Absolutely. And then Cheyenne was asking, what if it's a new development as far as closing with all cash? I think that's
So with a new development, same rules apply. It's just as fast as both parties can close. New development and any seller, they love to close it up fast because that means it's a done deal for them. So it's a very attractive way to position a contract. So same thing, just depending on how much time the seller and the buyer need. It could be as fast as 5 days. It could be 14 to 21. But I would say on average, it's about 14 days to 21 days. just depends on all the scenarios and what you're willing to forego and give up, and as far as inspections and stuff like that. But that would be, I mean, I can go into that, but that would be a little bit more on a personal level as to, you know, how fast it can go. But it could be quick. So if you're over your house and you're ready to get into a new quarantine house, maybe that's where this line of questioning is coming from. We can get you in there fast if you found the right place.
Yes.
Yeah.
Perfect. She says, thank you, ladies.
Awesome. Okay, good. Glad we answered that. Very good.
Joe, did
All
we
right.
answer your question correctly? I'm sorry. I didn't know if we answered it for you.
Who did you ask for?
Joe,
Oh,
about
Joe.
if we satisfied his question.
Oh yeah, Joe, can you type in if that was good or if you had more about that question? And as he's typing, I want to thank you guys so much. This is our first virtual home buying seminar, so I hope that you got value out of it. We're here to educate, and I hope you feel very knowledgeable. And if you have, oh good, Joe said yes. If you have any other questions, you can reach out to us. Just scroll up in this chat. You can find all of Gina's information and myself. And I love you guys. I know I don't know some of you very well, but I love you anyways. I'm a lover, and I hope to always I hope to always bring you cutting edge information, up to date information and data, because I want you to make your decision and deepen your wealth from a place that's going to only support you. And I hope that that came across in this seminar with Gina and I.